this is the topic of my presentation. Working on this research today, it is still a little bit preliminary. So the question, what are the numbers of increasing tax revenue in Spain? What is the motivation? The motivation that shows the trend in Spain of expenditure section in red and over GDP, and in gray we have all the revenue of the administration to GDP. So up to the Great Recession, in fact, there was a, but then you see how in the recession the increases, we have that peak, and for this that today from 60% to more than 100%. Let me also point that although there was a convergence in that is a while, but very slow. And that's just before the peak of the COVID shock. This difference was like 2.9 percentage points, but then expenditure increased a lot, and we have a big gap now. And the shadow part, what shows is that the projections of the what the projections show is that it's going to take a while for this gap to increase. And moreover, for 2024, what it shows is that the difference is going to be bigger than we had in 2019. So we have this, what is telling us, that, well, there should be more ability of the welfare state. Okay. Analysis of this fact. Now, related to this, we have this other graph. What we well, this is instead of is the variable fiscal rate. Fiscal rate shows the taxes and social security contribution to GDP. For Spain is the green, and what we have on the top is the average of the EU 28 countries. Okay? So we have a difference that in 2009 is about like 7 percentage points. During this time, in Spain has increased, but still there is a difference about 5%. Now, some institutions, people think that when they see this, is that look, adapted in Spain, this gap should disappear. Actually, I'm not going to say that I agree with this view, but that's the way that and economies and in fact, if we look at the recent plan of the government, Plan de Resiliencia, Transformación, the announced Spanish government objective in the Spanish, what it says. This says that, well, that we need to have the fiscal system. We need to make it more progressive, and we need to increase the level of taxation so that we get closer to the European countries. And in fact, they mentioned the difference in fiscal sector of 7.6%. So what I'm going to do, motivated by this, I'm going to build a general equilibrium model of the Spanish economy. This model, the main features I want you to take from the model that are important is that the model is rich in Spain. So you're gonna see a model where we have labor income taxes, corporate taxes, consumption taxes, wealth taxes, inheritance taxes, capital taxes. This model, production is organized by corporate sector and entrepreneurs. It's important in the model because it helps to reproduce the level of concentration of wealth that we have in Spain. The fact that there is a high concentration of wealth. And I'm going to use this data, a laboratory, to evaluate tax reforms that have objectives to increase the tax revenue. So I'm going to increase the tax revenue, and I'm going to quantify so in doing that, I'm going to call NESI. So NESI, García Miralles, and Ramos, paper published in the 2000. They estimate with this function, they estimate the effective tax rate on labor income. So it's in fact it's labor income and self-employment. I want to show you right now this function because I want you to take two parameters taxes in Spain that are this parameter lambda that measures the average tax rate. What we have there in the parent is the relative income of an individual. So if that number is 1 minus lambda tell us the average tax rate. The parameter tau is the degree of progressivity of the taxes, okay? Effective taxes. And what NESI and co-authors do is to use microeconomic data, to use data to estimate lambda and tau. And there is another objective that is important. If the income is less than I have, okay, the tax rate is. So that's the example. And that's another object that they use. Okay, so the experiment that I'm gonna run, they're gonna use this framework, and what I'm gonna do is to see how much more revenue you can make by changing the progressivity or changing the parameter lambda. So preview the results. The results are these. I'm going to tell you already what I find. First, increasing the progressivity of income taxes, increasing tau, has minor effects on tax revenue. So, in fact, the estimated value of tau of NESI and authors is very close to the one. So, by increasing tau, why is that? Well, because when you increase tau, the revenue from personal income taxes is you have an effect on your tax sources. And that's important actually take into account. That's important. You have to take into account all other tax sources. You have to model all of them at the same time. Now, I also find that output decreases when you increase productivity. This, in fact, is explained because when you tax entrepreneurs, the money income, there is a reallocation of production also from the entrepreneurial sector to the corporate sector. And that is important to explain the changing algorithm. And also find important quality. By increasing progressivity, we have a decrease of the quality in income and in consumption. So that's the first of the results. And then I after this time, found that the effects on rising tax revenue are small. Well, I thought, well, what about we think about other reforms that try to tax basically the rich people reaching income or reaching wealth, how much more tax revenue we have paid? Well, I try to increase the income taxation of the top 5% income rich, and I also find the small effects. I also try other reforms that what is reforming the wealth tax in the state. So taxing not like now, we are taxing the top 1% richest wealth individuals. What I do in my reform is to tax the 5% and increase the tax rate. I find the small effect. What about taxes on inheritance or increase taxes on capital income? The effects are small. It's not related to the difference. Okay, so then next, simple what we need to do by just changing progressivity or tax motivation to the rich, we can match tax revenue, the overall level of tax. So the previous function that I showed you, let's well, I think the value of lambda, that is the effective tax rate on personal income. To be more precise, on their sales general income, of less stable income, and employment income. Okay, so measure that and to search for the level of lambda that maximizes the total tax rate. And I find that we can increase the total tax rate up to 3%. That implies an increase of the ratio of 6.5 percentage points. Okay, so that's what the government was pointing in their plan. Now, this is possible in terms of output. Output decreases 7.6%. Now, inequality decreases. And the Gini goes down from 0.37 to 0.35. Now, with this one, we see tax increases because the central level is not changed. It's the same. That's constant. And in fact, you are going to see so that that's a central level. Like that. Big fraction of people in Spain, they are not paying tax. The effective tax rate you see. The last finding that I want to show you is that the tax rate increase a lot by increasing the consumption tax. And the consumption tax, in fact, the findings in the previous doesn't have any growth in terms of output. No output, but on the other hand, there is no decrease in the output. Inequality is not affected by this decrease in consumption. Okay? Now, this work is related to the work of people that are here today, like Messi already mentioned, people, Juan Carlos Conesa, they have a very nice paper about the trends in labor supply in Spain and how to practice. And Messi has a study with co-authors, the progressivity of labor income taxes and the effect of total tax revenue. Here, relative to Messi and co-authors' work, I'm considering a complete, let's say, set of taxes, because I have 12 taxes and I also modeling entrepreneurs to match quantitatively very well the upper tail of the distribution of income and distribution of wealth. That relative to Messi. Okay? So there is a literature on that, entrepreneurship and inequality, Quadrini, Cayete and Denaro. Everyone. Okay. So some additional facts to take this question. How well this table shows that wealth in Spain is concentrated in the upper tail. I just compared there with Spain. This is data from the survey of the Spanish survey of encuesta financiera de las familias. So you see that the 1% richest 1% of wealth is a lot. I mean, it's not as much as in the US, but it's quite. Now, if we look at the 1% top rich houses in the States, 36% of them are entrepreneurs. Now, in the US, this is a high, 4%. So it leads to be quite, okay? So that's why I'm gonna model it. Okay? So the description of the model. Okay. So the model has this feature. The model has this feature. So here you have the utility fund. So you have that is down. Here you have the expected discounted utility of all the dynasty. Utility depends on consumption, and age is our work. And individuals in the right, they go through two stages. When they enter the economy, they are young, and they face a probability of becoming. When they become old, then of dying. When they die, the dying economy is the place of the child, the family, that they are. Now, these households, they may have, when they are young, every period they grow a labor productivity that is set W, and they grow an entrepreneurial productivity that is set P. So, given this productivity, they decide to be a worker or to be an entrepreneur. They also make decisions regarding savings and also legal support. So the production, there is one good, final good, that can be used for consumption and as productive capital. This good can be produced by entrepreneurs and by corporations. So entrepreneurs are subject to financial frictions, and they work, and they also, so they work in their own business, and they also hire labor. And corporations, they produce the same good, and they have a constant resource base. So let me tell you about the problem of the entrepreneur. This is the production function of the entrepreneur. Number set E is the of the entrepreneur, and has a production function to the and the higher capital and the space. Now the labor, that is L, is equal to N. This is the labor that they hire from outside, and depends also on age, so this is hours that they and set W is the labor productivity of the entrepreneur. Okay. So they use capital. Now they face this financial friction, that is the own asset A, and they use of capital K. Now K cannot be bigger than lambda times A. Okay, so that tells you how much they can borrow in order to invest in their business. So these are the profits of the entrepreneur, the same thing that I said before, which is the constraint on capital, and that's the constraint on labor. Okay? And the market price for capital, and then we have the corporate sector. So for the corporate sector, we have a constant resource-based technology, and that's the problem of the minimization cost problem of the corporate sector. Here you see a tau K, that is the corporate tax that is applied to this. Okay, so R is the return after tax, the people that are saving in their assets, that the return that they obtain, which is the market. Okay, so that's the production. how it's organized in the corporate sector. But here the idea is that I told you before that having entrepreneurs help to match the other way of the wealth distribution. Having heterogeneity in the returns to capital. People that are very productive as entrepreneurs, they are going to have high return of their investment in capital, higher than the return that, let's say, a worker obtains from the savings that is just the risk-free asset. No? So having this heterogeneity and also the fact that we have incomplete markets, so we are going to have an endogenous distribution of wealth in equilibrium, and we have people that is very lucky and they have high returns as entrepreneurs, they are going to accumulate a lot of assets. More or less, that's the picture. Okay? So what is the occupational choice? I'm going to tell you the difference between workers and entrepreneurs. If we have an individual that is a worker, he's going to decide the labor supply, he's going to earn a wage, and he's going to pay taxes. And then they are going to consume and save. And at the end of the period, they might die, they might become old. Okay. If a worker becomes old, he's going to be retired from the labor market. On the other hand, we have entrepreneurs. They decide their own labor supply, they earn profits, and they pay taxes. They consume and save, and they might become old. If they become old, entrepreneurs can decide whether to keep their business or to retire. Okay? And then retired entrepreneurs, they are going to face the probability of dying, and the same for retired in general. A worker that retires is going to also face that probability. Here I have the value functions, the Bellman equations. I don't plan to show you those expressions, but if anyone is interested, they're there. Okay? So the government, I have, so there is a government that consumes G, and they implement a transfer and tax and transfer program. So I have a complete set of taxes trying to mimic what we have in Spain. So there is a personal income tax, capital and labor income tax, a consumption tax, a progressive tax on inheritance, a wealth tax above a threshold, a corporate income tax, and mean-tested transfers. Okay? The government also administers a pay-as-you-go social security system. There is a maximum contribution, pension, and the pension of an individual in the model depends on the last realization of the productivity. So there is also heterogeneity in pensions in this model. I assume that there is one budget constraint for the government for all these programs. So I abstract, sorry, a budget constraint that the video has been satisfied, so I am abstracting from public debt in the model. So in the taxation, modeling this taxation of personal income, I already said that I'm following the work of Garcia Miralles, Brunner, and Ramos. What is very nice thing I didn't know that I learned from this work is that to fit well the data on after tax income in Spain, you need to model or you need to estimate three functions. The first one determines what is the effective tax rate on labor income, labor and self-employment income. The second is the tax mimics well the taxes paid for capital income. Okay? Because it's progressive, but it's not as progressive, it's not the same schedule than labor income. And then the third function that they estimate is a tax credit function. So I just follow the work, and I have these three functions to meet the personal income taxes. And just say that I'm going to compute the stationary competitive equilibrium. So what I'm going to show you has to do with what we obtain in equilibrium in a long run. When I make forms, we're just looking at the long run situation, and we get to a stationary situation. Well, I'm going to go very fast over the calibration. Some parameters in the model and validate them without solving the model. For example, the probabilities of getting old or the probabilities of dying, the tax rates, etc. There are other parameters. Well, these are the parameters that that they estimate for Spain. I'm going to use those parameters from tax returns in Spain. And there are other parameters that I calibrate within the model in order to minimize a loss function. I'm comparing statistics in the Spanish economy with statistics. For example, I want to be consistent with the concentration of wealth in Spain. I want to reproduce that the top 1% richest in the model, they own 21% of the wealth in Spain. And I also want to mimic the Gini of earnings, the distribution of pensions, one type of distribution. So I have these stats. Okay. Now let me show you about the fit. How well this model can fit the inequality in income and the inequality in wealth in Spain. Well, this is the wealth distribution. And what is important here is that a model with this model with entrepreneurs can match the top tail of the wealth distribution, as you can see here. And also interesting to see that the bottom, they own very little wealth. Okay, for that, modeling entrepreneurs is crucial. Income distribution, the same thing. You can match well the top by having these entrepreneurs that helps. Okay, so the model does, let's say, very well matching these distributions. Now, what about the distribution, the shares of personal income taxes paid across the income distribution? Well, the model, I want you to focus here. Okay, that's something that is interesting is that the two first quintiles, they pay very little wealth or not, taxes, personal income taxes or nothing. The model does well in matching the share of taxes paid by these top from 92, 95, etc. Here is a little bit exaggerated. In the model says that the top 1%, they pay more than what they pay in Spain. So that's something maybe I should study more why I get that, but this is what I get. So, okay, so I don't know how much time I have. 15? Okay, so the first experiment, so remember, the question is, first, what kind of reform can increase tax revenue to substantial amount so that we get close to these other European countries? Can we do that by taxing rich people or rich in income or rich in wealth? So I'm going to increase first the tau parameter, the progressivity. Okay, and well, this is just the function that Nessie and co-authors estimate again, and the blue curve is the baseline economy. So these are the parameters that they estimate, and notice that this graph over here starts in 0.5. That means that for income levels below 50% of the average income, the tax is 0. Okay? The effective tax is 0. So in this, with this tax function, if we increase progressivity, this is what happens with the curve. It moves up, but rotates through, in this point, okay? And the curve that I have below, but very close, is the one that the value of tau that increases the total tax revenue in this model. So what it says is that, in fact, to increase the tax revenue, I need to decrease progressivity a little bit. So that's the time. And that's the value of tau equal to 0.15 is the one that I find that increases tax revenue, but very, very little. And I want you to take from here that increasing progressivity is costly in terms of output. If I increase the progressivity, output decreases. And output decreases overall, that is here, But notice that the effect on the output produced by entrepreneurs, that is this YE, this is what entrepreneurs produce, and this is what corporations produce. So increasing progressivity affects the production of entrepreneurs because we are taxing entrepreneurs with this at a more progressive degree. Okay. Okay. So there is a reallocation of capital from entrepreneurs to corporations. Okay. Total tax revenue increase very, very, very little. Now, if we increase progressivity, we increase fiscal pressure, but very little. Okay. Now, why is that? Because, well, on the one hand, by increasing progressivity, we increase the revenue from personal income taxes, but the revenue from social security contributions and the revenue from consumption taxes go down. These two are big in terms of the total tax revenue. What are the big contributors are social security, payroll taxes, consumption taxes, and personal income taxes. Okay, you need to model all of them at the same time to see whether total tax revenue is going to increase or not. There are, in fact, increasing progressivity decreases inequality. Okay, so we have a decrease in output, but inequality also decreases, or an inequality also decreases. Okay, can we get more tax revenue in other ways, taxing more the rich? Well, I try different things. And I'm going to show you first a table about that. So I try to tax more the top 5% income rich. I try always, when I say I try many reforms with the objective of maximizing the tax revenue. So I'm looking for what maximizes the tax revenue. I increase taxes on capital income. I try to increase taxes on wealth. I try to increase taxes on inheritances. And this is what I find. Here you have how much total tax revenue can increase with all these menus that I can consider. Each of these columns, what it tells you is for each of these reforms, which is the one that gives me the highest increase in tax revenue. Well, the effect is very small. Here in blue, just to, I think it's interesting that these other reforms have different effects on the output of entrepreneurs. If we increase progressivity of labor, or what NESI calls general income, which is labor and self-employment income, we hurt entrepreneurs, output goes down. Now, if we tax instead capital income, here is interest from assets, then, well, now it's more attractive to be an entrepreneur. So in fact, output of entrepreneur goes up. The same for wealth or inheritances. That's a co-author of mine, Georgi Tamburov, has a paper about this. Taxing wealth versus taxing capital income is not the same. But, okay, so by taxing more the rich income people or rich asset people, we cannot increase a lot tax revenue. So let's increase taxes. So I'm going to show you two results. We can increase effective tax rate on general income. So that's now this curve, this function, the NESI estimate. We're going to move it up, okay? Increase taxes. But the assumption level is kept constant. I'm not going to change that, okay? So people that have income that is less than 50% the average income, the effective tax rate is 0. So I try different values of lambda, and this is the total tax revenue. Has like a kind of a Laffer curve. And so this is the value that maximizes total tax revenue. Now, as total tax revenue goes up, output goes down, GDP goes down. So GDP decreases. So total tax revenue can increase up to 10%. When we do that, output decreases a lot. There is a cost in output of 7%. Okay? Now, what happens with inequality? Well, inequality, so this is the value of lambda that maximizes tax revenue. Inequality in consumption decreases. So why is that? we are increasing the taxes for everybody. Well, we are keeping the exemption level fixed. Okay? So overall inequality decreases. Okay? So that's the explanation. A large fraction of households are not paying this tax. And I am almost done. So the last thing I try, okay, I'm going to increase instead the tax rate on consumption. What is the motivation for that? And the motivation is that, well, it turns out that a lot of these rich people, many households that are rich, are retirees in Spain. So we have, if you look at the top 1%, richest households in Spain, 36% are entrepreneurs. Look, 46% are retirees. This is not the same in the US. In the US, most of them are entrepreneurs. 20% are retirees. The same if I look at the top 5% richest. I have then, and 51% of them are retirees. Okay, so these people are consuming. So let's tax consumption. Okay. Okay, so in the baseline calibration, the effective tax rate of consumption is 15%, the tax rate. So so that's the baseline. If I increase to 20%, total tax revenue increases. And if it's increasing more, I found that if I increase the tax rate on consumption, can increase a lot tax revenue. And then I found that there was not effect on output, nothing. So then I thought, oh, I have a bug in my program, in my codes. My codes are wrong. But then after thinking about that, I think there is a theorem. Maybe some of you that are expert in tax, but it's true. You can prove it. It's true. What I'm doing is right. I increase the tax on consumption and no effect on output. Okay. So there is no effect on output. Now this is because two things, because there is no tax rebate. So I'm collecting more taxes, but I'm not rebating that to households. With the utility function that I have, income and substitution effect, they cancel out. So there is no effect on labor supply. And with that, you can prove, in fact, in this framework, even with this equation of choice and this friction, financial markets, that is a theorem. There is no effect on output. But at the same time, there is no effect on inequality. So proportionally, everybody is consuming the same proportion less, and inequality is not affected. So conclusion, bottom line, there are very little gains in increasing progressivity of general income taxes, very little gains. Or if you increase other reforms that increase taxes on rich people, income rich or wealth rich. To increase the tax revenue, either you increase effective taxes on personal income or you increase taxes on consumption. Now, these two possibilities have very different implications. The first has large output costs and decrease inequality. But in the second, there is no output cost, but inequality is not affected. So you cannot reduce inequality with that. Now, what is the right mix of these two policies? Well, that is going to depend on the objectives of the government, depending what they want. What is more important? Increase tax revenue. You have to take into account the trade-off between output cost and whether you want to pursue a decrease in inequality. Okay? So that's my conclusion from all this work. And I'm willing to take questions if you like.
Thank you very much, Luisa. We do have time for questions. She has always been able to explain a lot in short time. So the floor is open, please. do we have a microphone?
Here. Yeah.
Ah.
Okay, thank you. So I was just going to ask. I mean, so I'm puzzled by the large output cost.
Mhm.
So in that regard, so what is exactly the government doing with the income, right? With the taxes, the money? Because I don't know to what extent you're modeling productive capacity from the public sector, right? And then related to that, so what is the evidence on higher taxes on general income leading to larger output costs?
Well, that's the
my
cost.
question.
There is a higher revenue, tax revenue, that is not being used for any productive use, of course. So here I'm telling you what is the cost in terms of output under that assumption. Okay, that's the thing. Yeah, that's the fair answer. Now you might consider other frameworks in which you, besides want to increase the tax revenue, you have an objective of using this for, I don't know, maybe infrastructure, other things that you might think that can increase the productivity of these entrepreneurs. Okay, but that's not the, let's say, it's not the game that I'm playing here.
Yes.
But the question is relevant. It's very important. What are you doing with this tax revenue? Also for the output cost. I mean, not only what I think you're thinking that is maybe you can give a productive use to that, but if you think that part of this is going to be rebated to households, then you are going to have a bigger effect on labor supply. Okay? Think that here you have income substitution effects, they cancel out because we are not rebating this extra tax revenue to households. If you rebate that, then you have an income effect and they are going to work less. Okay? So that is a very important issue when you study the effects of taxation. What is the government doing with this? Okay?
Yeah. So I was struck by the last result that consumption tax works so well in a way. So, and then you said this is a theorem, it has to do with how you specify the utility function. So would it make sense to fiddle with utility function to see if this holds?
Yes.
With, and I mean, is this important or not?
Yeah, no, of course it's important.
So
This is, I think it's a nice benchmark. It's simple and it's a nice benchmark that helps you to understand what is going on and to compare this to ways of taxing households. But of course, there I mean, it's very relevant to do. Now, I like this utility function because it's consistent with a balanced growth path. And I have a previous work with co-authors where we show that permanent changes in income, they don't have effects on labor supply. So this time is consistent with this balanced growth path preferences. I mean, utility function that is consistent with balanced growth path. But of course, that is relevant. And maybe you talk with a microeconomist, I'm macro, but if you ask a microeconomist, you're gonna, I know, but this utility function is, should have, it doesn't make sense to have these balanced growth path preferences. So there is a debate about that. Yeah.
A question about the financial constraint that is exogenous in this setup. I wonder if the two reforms will affect differently the financial constraint, because increasing progressivity, you are giving some insurance, so you could relax the financial constraint, or would you increase the lump sum tax, you're lowering the value of investment, so you could make the financial constraint more harsher on that. So I wonder what is your take on that.
Yeah, no, yeah. I didn't do any sensitivity on that. I just can tell you that the last result does not depend on that. It just doesn't depend on the constraint. It doesn't matter. And the proof is very simple. You can prove it. But of course, for the other results of the paper, that's something that is relevant to do. I mean, I try to calibrate that parameter with data on Spain. That tells you what is the leverage, maximum leverage of Spanish farms. So it's calibrated. But I didn't model an endogenous constraint. That I didn't do.
Well, first, thank you for the presentation. I really enjoyed it. The one common practice in Spain is tax evasion. And in your presentation, you have talked all the time about effective taxes. So you can get more effective taxes, either increasing the theoretical or the official taxes, or just changing enforcement. And maybe this tax evasion is more concentrated, I don't know, on the entrepreneurial sources, or I don't know. So I don't know whether you have something to say about this evasion playing a role in your results.
Yeah, well, in fact, when I show you how well the model fits the share of taxes paid by each across the income distribution, the model tells you that the very rich, they pay more than what they pay in Spain. So I don't know why is that. Could be tax evasion, could be that. Not sure. I'm not sure why, but maybe it could be. So of course that's important to model, to take that into account. As you said, these are effective taxes. And the exercise that I'm doing, I'm just increasing effective taxes. So you can do that by, for example, reducing tax deductions, increasing tax rates, or maybe reducing tax evasion. Yes, that's all of that, let's say, is there in this reduced form way.
So I was going to ask about the similar thing, but I'll change the question. So in the one concern is what you were saying, that what the government does with the money, but also it matters whether the public sector might crowd out the private sector, right? So if the effect of the tax is that then private sector output decreases and public sector output increases, this is also crucial, no, to see the effect. And in particular, I was wondering if this is what happens in other European countries. So in other European countries, they raise more tax revenue. Do they also have a larger public sector? France for sure does, but on average?
No, I think that's related to what I said before, and I think it's very interesting to consider in this type of exercise about taxes. It's very important, and I learned this from the work of Prescott that I mentioned, that is very important. What do you consider government expenditure in the model? What is G, expenditure? So in that paper of Prescott, he said, well, G is just what is really public good. So in his model, he has just expenditure in military and in the police and the judicial system. All of that is just public good. The rest is private good. So in his model, all that, well, he considered that is not a public good, is transferred back to households. Okay, and of course that is important for the reaction in labor supply because you are giving a transfer. Okay, now I thought about that. Whether to consider that type of exercise in my framework. But here I think what you are talking about, or trying to measure tax revenue and modeling consumption taxes, that you have to be, I really don't know how to approach that, because then you have to be very careful in modeling very well what are the use that the government is giving to this tax revenue. You need to model if it's that the government is spending this in health, public education. You need to model to model those goods in the utility function, and to, what I mean is that you cannot just give a transfer to households because they will use those transfers
to buy the consumption good, and they will pay the consumption tax on that, and that will affect the overall tax revenue that you collect. Okay, you don't want to do that, because if they are enjoying that good offered by the government, they are not just paying the consumption tax on that. So I think I'm making a little bit of, maybe I'm not explaining myself very well, but overall, what I mean, bottom line, what I mean to say is that to get an answer on the model about tax revenue, if you want to, I think it is important to model the expenditure, no? in the categories of expenditures that they are in reality. So that you need to model what is health expenditure in health provided by the government, expenditure in education, all these goods that are substituting the private goods, no? But that in a way that it doesn't affect what the model is telling you that the households are paying as taxes, as consumption taxes. And of course, and I think that you also mean that there will be a different type goods of this type. I mean, the structure of production in public offer goods or government offer goods and private offer goods will be different, and probably is different across countries. Okay, but that's something that is relevant also for the tax revenue, and I'm abstracting about that in this framework. But I think it's something that is interesting to pursue in further, and I think that that's an issue that is important, it's relevant.
Some last question? Okay, so let's thank again Luisa
Okay,
for this
thank you.
excellent exposition.